Welcome back to The Explainer. Today, we're diving deep into one of America's absolute utility giants, Charlotte-based Duke Energy, trading under the ticker DUK. Now, if you follow the utility sector, you probably think of these companies as, well, stable, steady, and maybe just a little bit boring. But right now, Duke Energy is right in the middle of one of the most massive transformations in its entire history. We're literally watching a historically sleepy, reliable dividend player completely morph into a high-growth AI infrastructure play. The demand for electricity is shifting in ways we simply haven't seen in decades, and Duke is sitting right at the very center of America's energy revolution.
Okay, let's dive into this agenda. We're going to do a systematic breakdown here. First, we'll look at a utility transformed, then the data center boom, followed by their $100 billion plan. Then we'll navigate the regulatory roadblocks and wrap up with the Wall Street outlook and the risks involved.
Section 1. A utility transformed. To understand where Duke Energy is heading, we have to look at its historically massive and very predictable footprint across the Southeast and Midwest.
To really grasp this paradigm shift, think about the old Duke versus the new Duke. Historically, we had a world of essentially flat electricity demand. It just ticked up slightly alongside regular population gains. But today, the new Duke is facing exponential load growth driven entirely by AI and data centers. The sheer scale of this new infrastructure paradigm is, frankly, breathtaking.
So let's ground ourselves with a baseline from August 2026. Duke's Q2 results were incredibly solid. They delivered a 14.4% year-over-year jump in adjusted earnings per share to $1.43, comfortably beating the $1.32 estimate. On a GAAP basis, EPS came in at $1.38. Now, revenue did hit $7.59 billion, which was a slight miss on the $7.61 billion forecast. But actually, scratch that as a negative because that miss was primarily driven by lower natural gas costs and reduced operation and maintenance expenses, not a lack of demand. In fact, operating income grew from $1.83 billion to $2.05 billion compared to last year.
And building on that momentum, adjusted EPS for the first half of 2026 reached $3.36. Because of this really strong foundation, management reaffirmed their full-year 2026 adjusted EPS guidance of $6.55 to $6.80. But here is the major takeaway. Management is so confident in this trajectory that they're projecting 5 to 7% long-term growth through 2030, and they actually expect to hit the top half of that target beginning in 2028.
Section 2. The data center boom. Let's talk about the inciting incident of this whole narrative, the absolute explosion of artificial intelligence and cloud computing driving unprecedented electricity demand.
Now, what's really interesting about this is the sheer scale. We are talking about an extra 15.4 gigawatts. Duke has already secured 7.8 gigawatts of electric service agreements with data center customers. That's a massive number on its own. But they're in advanced discussions for an additional 15.4 gigawatts in their late-stage pipeline. The sheer volume of power being negotiated right now is historic.
Let's actually pause for a second, because we throw the word gigawatt around a lot in the energy space. To truly grasp the physical footprint of this data center boom, consider this. Of the demand Duke has already secured, about 5 gigawatts is currently under construction. 5 gigawatts is literally more than triple the output of some major nuclear and fossil fuel power plants. That is just an enormous amount of energy being consumed by server racks and AI computations.
And when you plug that kind of infrastructure into the grid, the company's growth curve alters entirely. Look at the acceleration here. Duke projects enterprise-wide load growth of 1.5% to 2% for 2026. But from 2027 through 2030, that jumps to 3% to 4% annually. And post-2030, it ramps up to a steep 4% to 5% annual curve. This isn't a blip, it's a fundamental shift in how much electricity the grid has to deliver.
So how exactly does a utility answer that kind of exponential load growth? Well, Section 3, the $100 billion plan. Duke is embarking on one of the largest capital investment programs we've ever seen.
$103 billion. Just let that number sink in. If you're a ratepayer or an investor, this is where your utility bills and portfolio metrics meet reality. Spanning from 2026 to 2030, Duke is deploying more than $1 billion every single month across its regulated capital plan. And the end goal of this incredibly aggressive timeline is to add 15 gigawatts of generation capacity by 2031.
But you know, funding a massive $103 billion build-out requires some serious capital maneuvering.
On August 10, 2026, Duke announced an equity raise of approximately $1.75 billion by selling 35 million equity units at $50 apiece, with an option for another $250 million if needed. S&P assigned a BB3- rating to this offering, and they're going to use those proceeds specifically to redeem $500 million of outstanding junior subordinated debentures, repay commercial paper, and ultimately fund this mammoth capital investment program.
Section 4. Navigating regulatory roadblocks. Because, as we know, operating a regulated utility means that building massive new infrastructure inevitably brings intense oversight and political pushback.
For example, in North Carolina, Duke reached a settlement for a 3.4% average residential rate increase each year for 2 years. But it wasn't smooth sailing. North Carolina Attorney General Jeff Jackson flat out refused to sign off on the proposed settlement, stating it was, quote, still too high. At the same time, environmental groups continue to push back on these rate hikes. The reality is, securing this funding impacts consumers' wallets directly, which creates inevitable friction.
And we're seeing that friction across multiple states. Systematically speaking, in South Carolina, Duke is taking an appeal all the way to the state's Supreme Court because regulators denied a 4% rate increase, citing a one-year wait rule that Duke argues goes against legislative intent. Down in Florida, regulators are heavily scrutinizing Duke's data center tariffs to ensure residential customers are protected. And back in North Carolina, a Utilities Commission chairman actually halted the procurement of new solar farms unilaterally, a move that clean energy groups are now challenging.
So, the crucial point is, how does Wall Street weigh this massive AI upside against the real execution risks? That brings us to Section 5, Wall Street Outlook and Risks. Looking at the analyst consensus from August 2026, out of 22 analysts polled, the general consensus is a solid buy. We're looking at $137.56 average price target, which implies about a 12% upside. But notice the recent price target trims. Firms like JP Morgan, Truist, BMO, and Barclays have actually cut their targets a bit. This is largely due to more cautious sector views overall and some updated assumptions regarding discount rates.
And a major reason for that caution is the valuation premium. Duke's stock is currently trading at a forward price-to-earnings ratio of around 18.6, compared to the broader utility industry average of just 16.3. Because the market has already priced in a ton of this expected data center growth, analysts, including Investing Pro, consider the stock overvalued relative to its fair value. Basically, a premium multiple leaves Duke with a lot less room for error if earnings happen to slip.
So, to rapidly summarize, there are 5 major risks here. 1. Regulatory uncertainty from rate cases. 2. Interest rate sensitivity, since higher rates inflate the cost of that massive capital plan. 3. Execution risk. You have to deploy $103 billion flawlessly. 4. The valuation premium we just touched on. And 5. Serious competition from giants like Nextera and Dominion who want the exact same data center business. But you have to weigh all of that against Duke's defensive appeal, specifically a highly attractive 3.57% dividend yield that they've raised for over 20 consecutive years. Which leaves us with one final, vital question. With a steady 3.57% yield backing up an unprecedented AI-sized transformation, is Duke Energy's $103 billion gamble going to successfully build the grid of the future, or is it an overvalued utility pipe dream? The answer to that is absolutely going to define the American energy sector for the next decade. Thank you so much for joining me for this explainer today. I definitely encourage you to keep looking into this transformation on your own, and I'll catch you on the next one.